Welcome back. Here tuned in to Halftime Report. Well, we have Strides Farmers numbers that are flashing for you on the screen. There's a bit of a revenue growth out there. It's up close to around 17%, but the EBITDA growth is only around 10%. That would tell you that the margins on a year-on-year basis would have come down a little bit. So let's get that number up for you. Yes, it's coming at around 20.8%. That compares with around 21%. So not too much of a decline. But those are the numbers, and the stock, for the time being at least, is coming off the high point of the day. The net profit number as well has jumped up by close to around 10%. Sonal will be watching these numbers. She'll join in when she has a better sense of that. For the time being, though, let's move on to APL Apollo Tubes. Now, they posted a good set of numbers. The revenues were up, the volumes were up, the margins as well have expanded. But what's the way ahead? We have Mr. Anubhav Gupta, the Chief Strategy Officer, who joins us. Hi, Anubhav. Thanks so much for joining in. Well, fill us in with a couple of details. Firstly, what is the sales volume target that you have for this year? At the halfway mark, you've done around 720,000. And also the EBITDA per ton at around 3,500 rupees per ton is looking splendid. Can you keep this up, or can you head towards that 4,000 per ton mark? Go ahead.
Thanks. Good afternoon, Nigel. So if you see our first half performance, we are at around 42% of last year volume. Now, going forward, if we see the momentum, what we got in month of September, if it does continue for the next 2-3 months, the third quarter should be equally good, and we can target to reach or match last year sales volume number. But except for that, what we are currently focusing is on the higher market share and rural sales push. So these two things, if we keep on hitting on them, like what we have done in the last 6 months, I'm sure that meeting or matching the last year's sales volume number is achievable.
Okay, last year's sales volume number achievable. Your margins have also expanded. I want to understand from you, which are the segments that are doing very well, where you see more demand, and is there further margin expansion that we can expect in the second half of the year?
So, Sonia, the EBITDA per ton is a resultant of two things. One is our lower fixed cost, what we have achieved in last 6 months, and second is the increased sales in the value-added products. So fixed costs have been fully absorbed in our system at the lower levels, and value-added portfolio also keeps on growing month-on-month basis. So I guess our target is that we should be around 3,500 per ton kind of EBITDA spread for the full year.
Okay. All right. So you're looking to maintain these margins. That's pretty good news. And you also said that your value-added products is increasing. What does it form as a percentage of your total sales? If you could give us a number. As of now, what is it? A year back, what was it? And also the other impressive fact about your numbers is that you've reduced debt from around 750 to around 300 crores. Now you're generating a lot of cash as well at the half-year mark. Will you be debt-free by the end of this year?
So coming to the value-added portfolio, right now it is 40% as we speak today. Last year it was 35%, and before that it was 30%. So every year we have grown this portfolio incrementally, and our target is to take it to 60-70% over the next 3 to 4 years. And given the pipeline what we have in the value-added portfolio, this also seems achievable. As far as the debt is concerned, again, it's a function of two things. One is our working capital improvement. If you look at our net working capital cycle days, it has improved to 7 from 27 in the last 6 months. So our operating cash flow was around 650 crores in the first half, which we have used to repay that debt, which is down from 800 crores to around 300 crores. And given the cash profits which will come over the next 6 months, we should be near zero debt end of this financial year.
Okay. I was going through your presentation, and in this you have a complete COVID-19 action plan where you talk also about reducing your fixed costs, minimizing your marketing expenses, etc. Can you tell us overall how much of costs have you already reduced up until now in H1, and any more cost reduction plans that you have which will aid margins?
So, Sonia, in fixed cost, there are 2-3 main elements. One is, of course, the employee cost. Second is the normal administration expenses. And third is the interest cost, which obviously is below EBITDA, but that's a fixed cost. So the employee cost per ton is down by 20% in last 6 months. The interest cost is down by 60% in last 6 months. And also the general admin expenses per ton are also down by 10 to 15%. And we are already doing sales volume much higher than what we did last year. I mean, our first half, our Q2 numbers demonstrate that. So this means that our system has fully absorbed this. Our efficiency has improved significantly. Going forward, now there are some variable costs where we are working on, like freight cost per ton, like power cost per ton. We do plan to bring more efficiencies here, which can further reduce our cost structure by the end of this.
That's good in terms of cost structure, Anubhav. But what from here? You'll be net cash. So what do you do with that cash? If you could give us a sense out there.
So Nigel, the first target is to, of course, become zero debt. If you look at the APL Apollo history, in last 10 years, we have grown at 27% volume CAGR. So every third year, we have been doubling our volumes. Today, we have capacity of 2.5, 2.6 million ton, and we are at 1.7 million ton. So for next 2-3 years, we have enough capacity to utilize it and demonstrate good volume growth. But then we will spend some money on the value-added portfolio, where we might do some capex, do some highly value-added products, which will aid margin and improve our ROC.
Okay.
So I guess in next 12 months, we shall take a call that once we have the surplus cash on books, we shall see how to utilize it.
You said improve the ROC. Improve it to what level?
So ideally in our business model, if you see, the ideal ROC is around 30%. That's how our IRRs are calculated while doing any capex.
Okay.
But we have been at 20-25% because every third year we are doubling our capacity. Now that capex intensity will slow down, you will see that ROCs will improve to 25-30%.
You're doing the right things at the half-year mark, and the stock market is quite happy because if we pull up the last 6-month chart, we'll see that the stock has gained big time. Thanks so much, Anubhav, for stopping by. Wish you well for the second half of the year. You've given us big targets. Achieving that is something that we'll be tracking as well. Big gainer in the last 6 months. Well, let's slip in a short break. But before we do that, here's something that you, our viewers, should take note of. CNBC TV 18 and the National Stock Exchange have come together to promote investor awareness through our special campaign, Informed Investor. Now, that empowers you to make the right decisions with your money. Well, before signing a check, we always ensure whether it's crossed or not. Similarly, never leave anything blank on your KYC. Strike off unwanted options while filling the KYC form. For example, an investor who only wants to trade in equity segment will put a tick against it and strike off the F&O or the currency derivatives segments. Remember, not striking off the blanks in the KYC is like issuing a bearer or a blank check.